Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah and over the next 30 minutes we'll talk all about mutual funds. Yes, we've been answering some queries as well all through the last few shows and this time around will be no different, so do send in your queries if you have them. The topic for this week's show is what to do if you indeed want to diversify out of equity mutual funds, whether you want to get into debt funds, money market funds, and whether it's the right time to do that. Now let me establish the case out here, and I'm not saying this is the scenario over the course of the 6 to 9 to 12 odd months. I'm just trying to show what happens typically, or what has happened typically in some of the funds when yields have behaved in a particular fashion. Now this is the scenario from July 2007 to Jan 2009, about an 18-month period, wherein the 10-year yield fell and the performance of some of the fixed income funds or money market funds did reasonably well. Look at yet another example. I think July or Jan 2013 or thereabouts, or 11, from there onwards till 13, again there was a perceptible fall in what the yields did and the resultant movement in some of the fixed funds. So not surprising, but remember, we are not trying to establish a case of this being the scenario over the course of the next 9 to 12 odd months. And therefore the question that comes to mind is that what should we as an average investor do if we want to diversify our risk out of equities? Should we go into money market funds, debt funds? Is this the right time when everybody's talking about the possibilities of further rate hikes from the Reserve Bank of India and maybe yields shooting up even further due to the global market factors? Let's pose that question to Suyash Choudhary of IDFC Asset Management Company. He joins us right now on the show. Suyash, so good having you. Thank you so much for taking the time out and speaking to us on the Bloomberg Quint Show, Mutual Fund Show. What's your sense, Suyash? Everybody talks about how the yields have gone up, but this may not be the end of it all, because of what the Fed could do and possibly because of what the Reserve Bank could do.
So, a lot of time is spent on what the 10-year of the bond curve is doing. I think, what is much more relevant and interesting is what the front end of the bond curve is doing. And if you see where 1 year, 2 year, 3 year, 4 year rates are, both on the sovereign and the corporate bond curve, those are, extremely attractive versus where the repo rate today is. So, just to give you an example, repo rate is at 6, and a 2-year corporate bond is almost at 8. So the question really to ask is, how much are we already discounting? And if you were to buy now, a carry of close to 8 versus a repo rate of 6, what is already embedded in the price? And our sense is probably 75 to 100 basis point of a rate hike over the course of a year is probably already in the price as far as the front-end rates are concerned. So yes, there is incrementally some pressure on macro. Yes, globally things have become more challenging. But on the other side, you're also getting rates which are starting off already pricing in probably 75 to 100 basis point over the course of a year.
Very interesting. Okay, now before we get to what would each of these rates indicate, let's just try and set the context of why would it be important for investors to log in or invest into, for lack of a better word, debt funds. They are not the ones which give those sexy returns. Why should an average investor think of parking money into debt funds?
Simply because of 100 rupees of your savings, you obviously don't want the entire 100 to be in the pursuit of wealth creation, that is equities or real estate or what have you. Because those asset classes are also subject to negative volatility. So, I would imagine, given the size of our fixed deposit market, that bulk of savings of an average investor actually go into fixed return products. True. And therefore, bulk of the savings actually chase income rather than wealth. So if that is really the criteria, you actually have to say, what is the core portion that should chase income? And therefore, how much of that core portion should be going into a fixed income mutual fund? And if then the argument shifts to whether it's a fixed income mutual fund or a fixed deposit, I would argue that a fixed income mutual fund probably wins, given the higher liquidity, diversification, and so forth. So really, it's not a question, I would imagine, whether you should diversify from equity to fixed income, but rather what portion of the pursuit of your fixed return money should be dedicated to fixed income mutual funds.
Do you have an internal formula in your head about what you do personally or what investors should do personally out of this portfolio which is chasing not wealth but income? What proportion should be in what kind of fixed income asset class?
So, Our thesis there is very simple. Look, India is a country where, the risk-free rate is almost at 7. So, unlike probably parts of the Western world, in India, you needn't complicate fixed income too much. And therefore, actually the context also there is that if you see most of investors into fixed income, they have recently converted from fixed deposits. And therefore, the mindset is very conservative. They would typically dislike volatility, and they would dislike extreme forms of risks even in fixed income. Now, if you apply this to fixed income mutual funds, you have to control for both duration as well as credit risk for the bulk of your portfolio. Now, the interesting thing, especially in context of the last 2 years, is that in India, people intuitively know how to control for duration risk. So they know, this is not the right time, for instance, to buy long-term debt funds because the NAVs have been volatile. But it's less intuitive to control for credit risk because credit risk does not, manifest as day-to-day NAV volatility. But what we would think is if you're trying to be conservative in fixed income, you should control for both duration and credit risk. Simply put, this basically throws up a basket of ultra short, medium-term kind of products which are largely AAA oriented.
Okay, interesting. And I think you're saying that go in for the AAA oriented, ultra short, and medium-term funds, and they should be the bulk of your investments.
That's
when
right.
you're looking at the fixed income
That's
investments.
Right.
Okay, great. Let's try and break it down for the benefit of our viewers because, at times names can be jargon. At times names can be confusing as well because of the plethora of opportunities available out there. What kind of funds, let's say, would you believe people should invest in? And we're taking an average risk profile, an average age, and an average investment time horizon. We can't really modify it for each of the cases. So let's go into averages. What kind of funds would you recommend? And let's then try and break down into what's the benefit of one versus the other. Say, for example, credit versus accrual funds, dynamic debt funds. What would you recommend?
So again, as a generic aggregate, I would imagine around 75% of your portfolio should be in conservative fixed income. Given that fixed income is not everything that you're doing. So fixed income, to go back to the initial part of our discussion, is for the pursuit of income. So 75% of fixed income should be in AAA oriented, ultra short, and medium term funds. Now, how do you determine, which funds are these? Unfortunately, the answer is not that simple, right? So you or an advisor who's advising you has to be able to see at least the fund fact sheets and fund mandates to determine whether predominantly a fund is AAA oriented or not. Okay. So you probably don't want to get into individual company level credit analysis, but to whatever extent the rating of a security mirrors the actual rating profile, you should actually be looking at funds which are at least 80-85% AAA for the bulk of your portfolio, which is around 75%.
Is this information easily available?
It is through public disclosures of mutual funds, okay. But you have to get into scheme level dynamics here. I mean, you can't just do it at an aggregate mutual fund level or even at a category level.
Oh, I can't do it.
No,
okay.
Probably not at a category level too, because credit risk is not really being controlled at a category level, barring 1 or 2 categories. For the balance 25%, you can pursue so-called alpha strategies, which means that you will take on risks that can actually manifest both ways. So if they're positively correlated to your returns, you will make more than what you make in the 75% of your basket. If they tend to get negatively correlated for a year or two, then you will delete from returns that you will make in the 75% of the basket. Now, in this 25%, we would actually speak of funds which take higher or more dynamic duration risk, where you could slot your dynamic bond funds, your gilt funds, your income funds, or funds that take higher credit risk, where you can put in credit opportunities or credit risk funds now in the new classification. So this 25% will be for the pursuit of alpha. The 75% will be conservative.
Okay.
Unfortunately, the way this is getting perceived by at least a part of the market is people think that duration is the only risk that needs controlling. So a lot of credit risk is actually being put as part of this 75% bucket, which in our very strong view should not be the case.
Okay, this might be a bit difficult for people to understand. So I'm just trying to simplify this. When you're saying duration versus credit risk, would you care to just completely dumb it down, Suyash?
So In fixed income, there are basically two types of risks that you take in order to generate excess return. One is interest rate risk, whereas the fund manager basically tries to increase or reduce duration alongside their or in view of the market dynamic or what they think about the market.
Sure.
And the other is through credit risk, where they take on a higher credit risk, which increases the portfolio running yield, and therefore they try to deliver higher return. So both these are legitimate risks. Is just that the manifestation of interest rate risk is through daily NAV volatility. So if, like you showed at the opening part of your show, suppose interest rates go from 9 to 7, that was the positive aspect of it. But like what's happened over the last 1 year, interest rates go from 6.5 to 7.75. So the interest rate volatility will work against you. So duration-oriented funds will actually post negative returns for you, and you tend to then get scared off from funds like those.
Okay.
However, credit risk funds will not typically manifest day-to-day NAV volatility, because credit risk is more of a binary risk. It will strike you if it has to strike you one day, and on that day it will erode a portion of your portfolio. But that doesn't mean it's not a risk just because it's not showing in day-to-day volatility. So 75% of portfolio, low credit and low duration risk or low interest rate risk, 25% probably more active interest rate risk and some bit of credit risk.
Okay. If you can again break this down, and then I will get in Jayesh Khilnani to talk about some of these schemes as well. What kind of investors should, say for example, go for what kind of funds? Because there are these accrual funds, there are these dynamic debt funds as well. If I am thinking of investing but want to understand what's the simplest way to understand the differences between the two, and whether these kind of funds are suited for my risk profile or no? How do I do it?
So you have to decide how conservative or aggressive you are with respect to fixed income. If your primary mandate is to secure some kind of a running income for yourself over, let's say, 2-year, 3-year rolling horizons, because even a conservative fund can be subject to near-term volatility, but over, let's say, 2-year, 3-year rolling horizon, if you just want to secure reasonable income, which is consistent with your other avenues on fixed income outside of mutual funds, then you should just look for products which are actually conservative. Now, average maturity on a product is very easily determined because there's a plethora of information on what the average maturity of a product is. For credit risk, you will probably have to rely on ratings, and like I said, you'll have to go one level deeper on the fund dynamic. Accrual is kind of a word that is much abused in our industry, frankly.
Okay.
Because within accrual, we try to parcel in credit risk. Right, so when we talk about accrual versus duration, it's as if there is just one risk in the industry, which is interest rate risk. And I can take higher average maturities, wherein I can take higher interest rate risk, or I can take lower average maturity, wherein I can cut interest rate risk. But I don't talk about credit risk when I speak of accrual. To us, pure accrual, so from a consumption standpoint, from a customer standpoint, from an investor standpoint, what should be accrual? Accrual should be steady income. Right, income that is probably not subject to any of the two investment risks that I mentioned in fixed income, which is interest rate risk and credit risk. And therefore, I keep coming back to the same thing. Pure accrual in fixed income can only be if you control for both interest rate risk, meaning you take short maturity, and you take conservative credit quality, which is AAA oriented.
Okay.
And then for the 25% of your book, the discussion is how much into dynamic bond funds and how much into credit. That's actually an individual preference. Left to me, I would prefer dynamic over credit, simply because credit markets in India are not yet evolved.
Okay.
So we have seen very, very large flows into the credit segment over the last couple of years, but we don't have liquidity in the secondary market. We don't have reasonable hedging mechanisms for credit, and therefore the ability to manage credit risk is very, very nascent as far as the Indian market is concerned. Whereas dynamic duration has proven track record of 15-20 years, where fund managers have seen multiple cycles. They have hedging mechanisms, they have liquidity, they have everything. So 75% very conservative duration or interest rate risk as well as credit risk, 25% largely oriented towards interest rate risk, but somewhat into credit risk as well.
Very interesting. Okay, before we ask Suyash about whether he believes this is a good time looking at the interest rate cycle to get into any of these schemes or no, he was talking about the dynamic debt funds and how, I mean, with the history that they have, they might be great funds to opt for, depending on your risk profile, of course. Let's tell you how have dynamic bond funds performed over the time when yields have contracted. Remember, we are not saying that this is the time when yields will contract. This is just to give you an illustrative example. But Jayesh Khilnani joins in with all those details. Jayesh.
So Neeraj, I've taken two time periods where the yield has contracted. For example's sake, we have taken the 10-year yield, and the first example is from November 2011 to May 2013, and you see that the 10-year yield actually came down from 8.9% to 7.1%. During this time period, what did the largest dynamic bond funds do? So we had the Reliance Dynamic Bond Fund, which gave you positive return of more than 25%. The SBI Dynamic Bond Fund gave you 25%. And the Aditya Birla Dynamic Bond Fund gave you just little less than 20% for return during the 2-year period that we are referring to. The next example that we have is from 2013 to 2016, where once again the yield actually declined from 9.2% to 6.6%. And during this time, once again, the fund managers, the dynamic bond fund managers got it right in terms of the Aditya Birla Dynamic Bond Fund giving you an excess return of 50%, and the Reliance Dynamic Bond Fund also giving you more than 51% return. The SBI Dynamic Bond Fund lastly gave you about 47%. But these are the largest schemes that we have in terms of the assets that they manage, in terms of the dynamic bond yield funds that we have.
Okay, thanks a lot for that, Jayesh. Suyash, the final question to you really is whether, from a risk profile purpose or otherwise, is this, timing is still would matter a bit. Would you try to time your entry into bond funds or money market funds? And if you do, hypothetically if you do, is this a good time to start looking at those funds? I know we're not saying out here for the third time, I'm repeating that yields are going to come off. At some point of time they will.
So, the good thing about fixed income is you will always get carry. So even if, let's say, yields go up from 8 to 8.5 at the shorter end of the yield curve, after they have hit 8.5, you start earning 8.5. Right, so it's not something that has been taken away from you.
True.
It is basically postponement of near-term mark-to-market benefits for higher carry income. Now, like I said, as an indicative example, today a 2-year AAA-oriented short-term bond fund has a portfolio yield which is roughly in the vicinity of 8%, give or take. Right, that is where a 2-year AAA corporate bond is.
Sure.
Now, if you were to examine this versus any other fixed income option that you have on the table, you'll realize probably this is one of the best going for you. Obviously, you'll have to subtract expense ratio from this. But at a gross level, 8% is where 2-year AAA corporate bond is. And that is what is reflected in a short-term bond fund's running yield. Now, is this something which is not attractive? Definitely no. It is quite attractive given where bank FD rates are, given where alternate savings options are. Can it get even more attractive down the line?
Possibly.
Probably yes. But given that you have income that accrues to you every month, why not also invest every month? And given that you have a very good head start, so where a money market fund or a liquid fund is, it's probably at around 675. Where a short-term fund is, the gross yield is close to 8%. So there's enough of a cushion that is built already that even if RBI were to hike over the next 1 year, you don't stand to bleed too much on return from where we are. And remember, whatever goes out comes back as higher carry down the line. Yeah. So yes, I would say this is as good a time as any.
Wow, as good a time as any. Okay. Suyash Choudhary, many thanks for joining us today on the Mutual Fund Show and giving us your thoughts and your wisdom. Much appreciate you being with us today.
Thank you so much.
Right. Well, that's the view from Suyash Choudhary of IDFC. He believes this is as good a time as any to go out and invest in some of the money market funds. We've had this discussion, and in case you've missed it, it'll be there on the website in just moments from now, so you can go ahead and look up that conversation as well. But if you want some piece of that conversation right now and want to understand what does an advisor feel about all of this, Nikhil Kothari of Etica Wealth Management joins us right now on the show. Nikhil, good having you. Thanks much for taking the time out. Suyash Choudhary was saying that it's as good a time as any to go out and invest into short-term funds, ultra short-term funds. What would your thought be? What are you telling your clients to do currently?
So I'll say that from a positive side, there's not too many positive coming in from the macro perspective. If I look at macro dynamic inflation growth dynamics, or if I look at external current account deficit numbers, or if I look at inflation numbers, it's been more stable. So we don't see too many positive coming in. But again, negatives are also subdued now with the inflation very much in control. So I don't think there were too many positive or negatives coming in. So from the rate cycle, we do more of a status quo for next 1 year. And from that perspective, people can invest in debt funds. But again, when you're investing in debt funds, I'll say we should not bet on something where we'll have an interest rate cut going forward. You should bet on something which will have a stable and you have a low duration funds. Because when you buy in low duration funds, then there's not too much of interest rate volatility. So even if RBI increase interest rates,
can you explain that again for the benefit of our viewers? What kind of funds would you recommend?
Yeah, so if some funds which are in a short duration funds, which they are not buying a too long paper, so funds which are buying 1 year paper, 6 months paper, 2 year paper. So there the good part is that even if interest rate goes up, the bond prices comes down very small amount. And because you get a carry, your effect, if you look at for 1 year, you get carry part which will take care of your volatility in the price movement. So I will say that if people who are investing right now should invest in short duration funds. So and if you have and you need to match with your horizon, your time frame. So what's your time frame? You need to match with that thing, but don't go in dynamic or long duration funds. Be in short duration fund in the current juncture.
Short duration is how short?
So you have various buckets in terms of funds. So again, it depends on your time frame. If your time frame is only that you want to invest for 3 to 6 months, you can be in ultra short term funds. If your time frame is 9 to 1 year, then you can be in low duration funds. And if your time frame is 2 to 3 years, then you can be short duration funds, short term funds. And if your time frame is 3 to 4 years, you can be medium term funds. So depending on your time frame, you need to select the time frame. Because what happens is that every fund invests in papers which are maturing in that time frame. So if you look at ultra short term fund, they will buy paper maturing next 6 to 9 months. So your time horizon matches with the paper maturity and you don't carry too much of interest rate risk.
Okay, I just want to repeat some of these timelines. The ideal investment for time horizon for different kinds of needs. So if you have a 1 month time horizon, then Nikhil says that a liquid fund is a good bet. If you have a 3 to 6 month time horizon, then an ultra short term fund is a good bet. It's 9 months to 1 year, then a low duration fund is something that you should consider. If it's 2 to 3 years, then a short term fund, and a 3 to 4 year time horizon, then a credit fund and a short term fund. This is for people who want to invest in a money market fund or a debt fund.
On a debt fund, right?
Or a debt fund.
And if you want to play a tactical call, which is saying that if interest rate likely to come down, which right now the scenario looks very, very low.
Yes.
So if interest likely to come down, then you can be in medium to long duration fund or dynamic bond fund. But that has to be pure tactical play. People who understand interest rate volatility. If I talk in general terms, if I look at retail investors, they don't understand when interest is going to go up or interest is going to come down. So in that time, I will rather recommend to be in short or credit risk fund as compared to pure long duration fund or dynamic bond funds.
Okay.
Because there you don't experience too much of interest rate volatility and you can expect a stable return on your portfolio.
Okay, are there any names that you would want to share? I mean, if a client of yours is coming to you right now and asking you for an advice on some debt market funds to put into money right now,
So
what would you
whenever
recommend?
someone comes and invests in debt market, the first thing what we ask them is what's the time frame?
Sure.
Because you can invest for as low as 1 day and you can invest as high as for 3 years or 4 years.
True.
So depending on time frame, you have to select the categories of investments. So if you say that, okay, I'm going to invest for 1 to 2 months or that, then I will say you can be in liquid fund and you have a lot of liquid funds.
You've told us. What about specific names?
Yeah,
Do you
so
have some names?
Yeah, so if you're looking at, say, for a time frame of 3 to 6 months or 3 to 9 months, then you can look at Franklin Low Duration Fund. Right? There you cannot, if you redeem before 3 months, you have exit load, but if you redeem after 3 months, there is no exit load, and you can expect a time frame 3 to 9 months. If you're looking at time frame for 1 year to 3 years, then you can look at UTI short-term fund or Birla short-term opportunities fund. They invest in paper which are maturing next 1 to 3 years. And if you're looking at 3 to 4 year or 3 to 5 year time frame, then you can look at some amount of credit risk fund. So where Birla medium-term fund or Franklin India corporate bond fund, you can look at those type of funds.
Okay, interesting. Now, we'll have some more questions on these, but I must say that there are some queries that have come in today which are not necessarily pertaining only to the subject of today's discussion. I'll try and pose them to you. If you can answer, it would be great to have those answers. There's somebody called Chinmay Kulkarni, I believe, on Facebook. He's asked us about how are fund of fund schemes, and if he wants to invest in a fund of fund scheme, should he invest or should I invest all of my SIP amount per month as the scheme is already providing adequate diversification? And specifically some questions about the quantum equity fund of funds. Do you have any thoughts on fund of fund schemes?
Yeah. So fund of fund basically as a concept is that you invest in one fund and the fund manager takes a call which all other funds you need to invest in. So it's basically you're buying one fund and that fund is again investing in various other funds. Now when it comes to fund of fund, the problem in India is that the taxation issue. Because when you invest in fund of fund, it classifies as a debt category. Okay, so it's not if you're investing in equity fund. In equity fund, if after 1 year long-term capital gain is only 10%, and you only pay if your income is more than 1 lakh rupees. But if you're investing in fund of fund, your long-term time frame becomes 3 years because that is classified as a debt fund.
Sure.
And if you're redeeming for 3 years, you pay short-term capital gain. And if you're redeeming after 3 years, then you have a long-term capital gain taxation. The second problem in fund of fund is that you pay a slightly higher expense ratio because you will paying the underlying fund expense ratio. Over and above that, you will be paying a fund manager another expense ratio to manage their other funds. So there's a dual expense ratio structure. So and a third point, the options which you have in fund of fund in India are very, very low right now. So what I rather recommend is that you depend on your time frame. You can select which fund you want to invest in, and you can take a help of advisor in that case, which you determine based on your time frame, based on your financial planning, which fund you should select in, and you can directly invest in that fund. Because in India we don't have any restriction because the minimum amount which you need to invest in a fund is 5,000 rupees. So it's not that you need to have a big amount to invest in various types of fund. So I rather recommend investor that please don't select fund of fund, rather be invest in underlying fund directly where you want based on your risk appetite and time frame.
Interesting. Saurabh Shetty is writing to us saying that he wants to invest 10 lakh rupees in a systematic withdrawal plan of 10,000 rupees per month with an annual increment of 10%. Where should he invest his money to get consistent returns and also ensure that his investment appreciates for a period of 30 years?
Okay.
It's a long-term time frame that he has in mind. Any advice that you have for Saurabh?
Great. So first, sort of you need to understand when you expect return of 10%, you need to carry some amount of volatility. Because if you want a stable return, you cannot expect more than 7 to 8%. If you're expecting 10%, you need to invest in a product which is a mix of debt and equity. Because debt alone cannot give you 10%, and equity, because you only expect 10%, you don't need a pure equity fund, because pure equity fund are slightly more volatile and can give you expect more return. So you need to select a hybrid fund. So here you have two categories of fund. One fund which is called equity arbitrage savings fund, where they invest 30-35% in equities and remaining in debt. And you have a balance fund which invests 65 to 70% in equities and 35% debt. Since your expectation horizon is 30 years, which is very, very long term, and you're expecting 10% return, I'll say you should select a balance fund, right, where you can invest a lump sum money, and from there you can select a SWP option, which is called systematic withdrawal plan. So we can fix the amount that I want to withdraw 10% of my principal, then it will be withdrawn every year. But when you're investing and doing SWP, you need to remember that in a short period of time, in next 1 year, 2 year, your portfolio value may be slightly up and down. You can withdraw your 10% every year on year, but your portfolio value may be up and down depending on what's happening in equity market volatility. But if you invest for 5 years and plus, because in 5 years equity market even out, and then over a 5-year period you will see that your principal more or less remain intact, and you can withdraw 10% every year. But here you need to withstand the volatility for short term. The ideal time frame to look at this type of fund is that you don't withdraw anything for first 3 years, let the money compound for first 3 years, and after that you start a SW for 10% every year. So in that case, what happens is that you will broadly see your principal remain intact, and you can withdraw that 10% every year.
Okay. I have one last question for somebody who's got, and let's make it short, but if for somebody who's got a lot of exposure into equity mutual funds, what's the ideal non-equity mutual fund to purchase in right now?
So again, depends on your time frame.
Let's say somebody has a time horizon of 10 years.
So I'll say if your time horizon is 10 years, I'll rather prefer 70 to 80 or 85% of my money in equities.
Yeah, but the person has 100% of money in equities.
Yeah, so if he wants to take out 10-15% of his money in debt, then he can invest in credit risk fund or a medium term fund. Because there, and your minimum horizon should be 3 years. Because then you get indexation benefit. And this type of fund, typically in this current scenario, should give you 8 to 8.5% return, which is a very, very decent return as compared to as a risk as compared to a traditional fixed income instrument, and it gives you a good diversification from your equity portfolio.
Okay, great. Thank you so much for taking the time out and being with us today. That's the view from the Etica Wealth Management team as well. But with that, it's a wrap on the Mutual Fund Show. Do send in your queries, and we'll request one of our guests to respond to them during the course of the next week as well. But thanks so much for watching this leg of the Mutual Fund Show.